the TheoTrade. This is Don Kaufman. It's May 8th, 2019, and you are watching the TheoTrade evening. 3 minutes left to the cash close. The S&Ps are down 9. You know, in today's trading session, we may have seen volatility take a little bit of a breather. But what I'm going to do in the next few minutes is I'm going to describe to you is, well, why volatility is about to be making a significant comeback based on much of the trade that I've seen over the last 3 sessions. Of course, that being Monday, Tuesday, and today, Wednesday of this week, there is evidence that we are on the verge of a major volatility kind of break, and that is a break to the upside in terms of volatility. With that, let's get to it. One of the first things I want to point out happens to be a specific level inside of the S&P futures. That level happens to be 28.83. Let me go ahead and mark it on your screen real quick so we just get comfortable with where that level happens to be effectively on your screen. This has kind of been the central point of trade over the last 3 trading sessions. Again, 28.83. Now, with that, and again, coming to the closing bell, I'm going to take you to a 30-day 1 hour. Again, a 30-day 1 hour chart. And I want to highlight this 28.83, which is just right in this neighborhood, effectively here. Okay. Now, I am not here to proclaim that this happens to be a gravity point, nothing of the sort. Nevertheless, okay, the trade in just the last few days, and this is coming into Sunday evening. This is starting into Monday, effectively into Tuesday, and of course Wednesday. This 28.83 has carried tremendous weight, and wouldn't be surprised at all to see us actually make it right there in and around the closing bell. Now, today's trading session was just a tweet-filled cluster. Effectively, what am I saying? I mean, here's a tweet prior to the market effectively opening over here. That's one tweet. Okay, we had responding in tweets throughout the course of the trading session. You will see, again, some wild 1-minute candles. Here, again, happens to be another tweet. I'm calling them tweet, but these are news drops that are coming out from both of the administration and, of course, China throughout the course of the session, making it, well, that much more dangerous to trade on an intraday basis. Nevertheless, as I was saying, and I'm about to display to you here momentarily, listen, we're on the verge of what seems to be a very substantial break to the upside in terms of volatility. Again, I'm going to take you into that right here, right now. One of the first things, that I want to describe isn't so much about the S&Ps. It's not so much about a 28.83 level, Then, of course, people are going to look at the VIX, and whenever I describe volatility or talk about volatility, people assume that I'm talking about the VIX. In this particular circumstance, I'm not. In fact, the VIX itself, listen, is nothing more than an equation. Here comes the closing bell. The VIX itself is nothing more than an equation, based on the SPX 30-day options, kind of an average of the 30-day options in the SPX. I'm going to push the VIX aside for just a moment. What we're going to look at over here, and by the way, there's our close, pretty much 28.83, close enough, right? What we're going to look at for a moment are the volatility futures. Now, as recently reported, the volatility futures are staring down the face of the largest short position that they've ever had on. And this actually deals with what we call the Commitment of Traders report. Effectively, what it says is, more traders are short volatility futures than ever before. And this is a trade that's been fairly consistent. I kind of call it the volatility suppression trade. As long as volatility is low, and here, for that, we can look, of course, at the VIX, and we could just say, hey, volatility has been incredibly low. In fact, this is one of the fastest collapses of volatility ever recorded in the VIX, right into this neighborhood. So traders have been effectively short volatility most of this way. Now, that short volatility trade maybe is starting, to rip apart at the seams. But I'm actually going to give you evidence of of just that not only is it starting to rip apart at the seams, but it's getting fairly serious. One of the things that I want to show you to begin with here in the volatility futures has to do with, some people talk about like contango and backwardation. Listen, I term it an inversion of the volatility futures, which is precisely what we have seen in the last again, kind of few hours of trade, both on Tuesday and Wednesday, the volatility futures are most definitively inverted. What effectively that means is, take a look at the 14-day vol futures. They're trading right here. Let's just call it, okay, 1820. They're trading at 1820. You go deeper into the future, which is 42 days out, and those little monkeys are trading, okay, let's just call that 1790. So what this is saying, and before I go any deeper into this, what this is effectively saying is, okay, the 14-day risk is exceeding the 42-day risk. And for those of you, if you've never been through when the volatility, futures are inverted, that's kind of confusing to think about. You're like, wait a second. The marketplace is saying the here and now is riskier than the future. Wouldn't you think that with 42 days versus 14 days, okay, in 42 days, a lot more can happen. The world can blow up a lot more in the next 42 days than it can in the next 14 days. But that's not the way the market is actually pricing it. The market is actually pricing the risk being here and the risk being now. In fact, there's what they call depth charts, okay? And in depth charts, you can actually see this stuff. And to do that, you can come right over here. This is actually product depth, right? And what you're looking at, this is VX product depth. And specifically, right, you got June, you got July, you got August, you got September. So we're totally inverted right now on the volatility futures, meaning that literally June volatility is exceeding August volatility. And you have to almost put a question mark to that. So once you have volatility futures inverted, which they are, not by much, but they absolutely are, that's when you have to actually step back and go, ruh-roh, all bets are off the table. This is where things can get absolutely nutty, and they can get nutty in a hurry. Now, I'm going to describe to you what is a fairly complicated trade with a lot of moving parts that's going on right now on the institutional side of the business. And this is why, okay, we could very well be on the verge of a break in volatility. When I think of a break in volatility, it's volatility exploding, all right, to the upside because, again, effectively we have so many shorts in this marketplace. Okay, here's what's going to go on. This is a volatility futures contract. Once again, we're just bringing up a chart. Now, when you guys listen, when you bring up charts and volatility futures, they almost don't even make sense. I'm going to zoom out for a second because they kind of break lower, then jump up and break lower. This is just different contracts. Look, just zoom into the most recent contract, right? So what's going to happen is if we see any degree of volatility inside of the S&Ps in the days to come, the volatility futures are going to escalate. As those volatility futures escalate, okay, you would think that a lot of traders have to do what? They have to get out of a short position. So if you're short, okay, this product, what do you do to get out? You buy it. The more you buy the product, the higher the product goes. Well, listen, okay, market-making firms, institutional traders, they're smarter than that crap. They don't turn around and buy, okay, the product itself to get out of it. How else could they mitigate their risk? Okay. As the volatility future starts to take off to the upside, and you can see it literally picking up right now, but as that volatility future starts to take off to the upside, what they'll turn around and do is they will buy, okay, VIX calls. Why are they going to buy VIX calls? Because VIX calls will actually cap their risk. Just give you an example. They could turn around, for example, and buy, okay, like a VIX. We'll just throw it out here as a 25 call. They'll turn around and buy a VIX 25 call. Now, the more calls you buy, okay, the higher the VIX volatility is going to go. The more calls you buy. Now, that'll cap their risk at effectively what? 25. The volatility future explodes, okay? And that VIX call that they purchase will offset that risk, anything above 25. Now, if you take a look at the VIX itself isn't necessarily going to dictate this, okay? You can take a look at the VIX options, go out to the June VIX options. First of all, if you start looking at volume and open interest, I'm going to open up just a few more strikes so you guys can see this. If you take a look at like volume and open interest, you're going to start to see some fairly hefty, of course, open interest out here, which starts to get scary. Now, today, there was not panic movement in the VIX today. There absolutely was yesterday. But nevertheless, we still have a very high VVIX. This is the volatility of the volatility index, meaning that buying the calls on the VIX is starting to get real expensive because clearly, okay, traders have been doing exactly what I just said. Right? They know that they're caught in a short position on these vol futures. So the vol futures take off to the upside. As the volatility futures take off to the upside, what do? They turn around and buy calls in the VIX. They buy calls in the VIX to hedge this trade-off. But buying calls in the VIX is what? It's expensive. So how do you pay for it? How do you pay for it? You go into the SPX. Okay, you go into the SPX options in and around the exact same time frame, and you start selling boatloads of out-of-the-money puts in the SPX. Okay, think about the convoluted nature of this trade. Now, if you sell boatloads of SPX puts, okay, that would impact the SPX. How would it impact the SPX? If you sell out-of-the-money puts, okay, it would actually tweak what we term the skew. The skew is out-of-the-money puts versus out-of-the-money calls, right? So let's go ahead and let's open up an option chain inside of the SPX to see effectively if this is going on. We'll actually pull up what we call implied vol. Now, okay, if this is true, there should be not only some open interest out here, okay, but there's going to be, again, a skew that doesn't necessarily look right. In fact, I'm going to show you that here momentarily. When I say a skew that doesn't necessarily look right, so these traders are in bad positions in the volatility futures. They turn around, they buy VIX calls, right? Because the VIX calls are extraordinarily expensive, then they turn around and try to finance that by wiggling their way out of the trade by selling SPX puts. But if you sell a bunch of SPX puts, the volatility in the SPX out-of-the-money options, these out-of-the-money puts, is actually going to go down. Guess what? That's actually measured by something called skew. Okay, and if you haven't looked at skew lately, in fact, I'm going to actually pull this up for you. Let's change this over to a line chart. Skew is incredibly low. Skew is incredibly low. Well, it's not the lowest reading that we've ever seen, but it's darn near it. Okay, this is over 3 years. Look how low the skew is. Why do you think the skew is one of the lowest points of 3 years? Because exactly the trade that I'm discussing, okay, is going on. All right, at this point in time, okay, everybody is looking at this and thinking it's all China. Okay, it has to do with China. It has to do with is this trade war going to go on? Yeah, but unfortunately, push China aside for just a second. Forget about the trade war. Now, okay, the volatility futures trade is taking on a life of its own. Okay, and because, again, so many traders are caught short this trade unto itself can actually start to really rock markets. Markets right now and moving forward are going to latch on to any catalyst they possibly can. If there is a hint of risk in the air, everybody's going to get jittery and want to bail the short volatility position. You got to look at the short volatility position. As I said, it's one of the biggest positions. It is the biggest short volatility position ever, but it is one of the biggest positions in the overall marketplace, okay? And as soon as this volatility starts to go up, it's like you're in a crowded room, packed. There's one door, and everybody starts to go for that door at the exact same time, okay? Any type of tweet, anything like, for example, bonds. Bonds are really close, once again, to what we term an inverted yield curve, okay? There was actually a brief and fleeting moment today where the 3-year, okay, the 3-month and the 10-year crossed one another, meaning that the 10-year, okay, interest rate dropped lower than the 3-month. That's the kind of stuff that's going to cause these markets not only to get skittish, but this volatility trade to go up in flames. One last thought while we're on it, okay? We could very well see some bounces. We could very well see some sell-offs. If we're going to bounce, we would think that we're fairly limited to the upside. Right here is the edge of the expected move. It's 29.11, which also happens to be effectively a gravity point. 29.11 to the upside. To the downside, listen, we're already outside the edge of the expected move substantially. Okay, right now we're approximately 30 points outside of an expected move. The expected move the entire week was only 34. Here's the crazy thing. Okay, you start taking a look at the SPX with just 2 days remaining, we still have a $45 expected move. Right? You need to expect, again, volatility. Yeah, the genie's pretty much out of the bottle. And at this point in time, again, the rally looks like it's going to be capped to the upside. The downside over here, it's deep. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.